And this is the Market Call Show. I'm the founder of WealthNet Investments, and on this podcast, we talk about things that could help you be a better investor, build wealth, and preserve your wealth. And today I'm going to be talking about a very interesting topic because it's all about being happy. The number one reason why people are not happy as an investor is because they don't manage their risk. They don't understand how to manage the risk, and they don't define risk. So I'm going to talk a little bit about what I consider to be the best way to manage risk. Now, most people are extremely bored when they hear the term managing risk, but I'm going to try to make this in a way that it's practical and it's something that you can actually use and own yourself and make yourself a better investor by thinking about risk in a way that makes sense and then turning that into actions that actually create happiness in your life and better investment results over the long term, because you're not varying your risk too much in a way where you're not creating results when you need to and taking the correct actions. So we all deal with problems with managing risk. Now, in my book, The Financial Freedom Blueprint, I talk about this. I talk about this in a chapter that is really talking about practical risk management. And I'm going to talk a little bit about that. I'm going to talk a little bit about what other people say about risk. And I'm going to start off with, there's a gentleman by the name of Ray Dalio. You may have heard of Ray Dalio. He was is the founder of Bridgewater, which is one of the largest hedge funds in the world, a very, very sophisticated risk manager and investment manager. And one of the things that he talks about is that there is a holy grail. There's really only one holy grail to investment management. And that has to do with being able to get multiple streams of returns that are not correlated, but they also have a positive expected return. And that is the key, the holy grail, if you will, because what it allows you to do when you blend more investments together that have a positive return that are not correlated to each other, they don't move up and down the same way, you tend to have a better risk-adjusted return, which means you could sleep at night. In other words, if you're making, let's just say you're making 8%, your risk of movements to the downside are lower if you have a better risk-adjusted return than if you have an 8% return that has high risk, right? So the idea of efficiency is brought into this equation, and I'm going to talk a little bit more about efficiency and how important that is. But one of the things that Ray Dalio talks about is that if you can get 15 to 20 good uncorrelated return streams, then you can actually reduce your risk by a ton, like 40% even. So that's a big, big thing, because it's easier for you to make an 8% return if you have 40% risk than if you had, the full risk. So there is a ton of merit to this. So how do we get past this whole concept of risk? I think we need to first define what it is. There's really a couple of ways of thinking about it, and you can get really esoteric from definitions. There's a difference between uncertainty and risk of loss. There really is no formula, and we don't have a specific formula. And this is something that I think that is interesting, because Warren Buffett talks about this. I was watching a YouTube video of him, or interview of him, and one of the things that he said is there is no formula to risk that we have. We don't have a specific calculation. We make our calculation of risk versus the reward in every transaction we do. We're going to be wrong. And this is the thing, you have to plan for being wrong. And I think that's the biggest thing, because most people, when they go into an investment, they're not planning to be wrong. And in order to be a happy investor, you must plan to be wrong in how you invest. And that is a big part of this. So we're going to be wrong, he says. You can't make a lot of decisions in the business without being wrong. And as an investment manager, there's a ton of decisions that we make, and we know that some of them are going to be wrong, and that's why we have position sizing. So one of the things Warren Buffett went on to say, he said, the main thing is, are you reasonably sure that you know what you're doing? Are you reasonably sure that you know what you're doing? If you can get past that hurdle, right? If you can get past that hurdle, then we go on to do the math. So before he even tries to go on to do the math, because he knows even his math's going to be wrong, but you have to make some estimate of that. And I'm going to talk a little bit more about that. And this is something that you as an investor don't have to do, but you need to make sure that whoever is helping you with your management of your assets are making these calculations, and whatever that risk profile that you have is aligned. Your portfolio is aligned with you, and that's the key, because otherwise you can wind up making poor decisions. So he goes on to say that he's willing to take larger risks if he feels that the rewards are more likely, et cetera, et cetera, et cetera. And there's a hurdle rate. But let's not get into all of those details, because that gets pretty esoteric. We can get into a lot of mathematics in terms of that. But what really matters is defining what your risk is in terms of just fluctuations, because there's going to be fluctuations no matter what. So the first thing I would also add to that point is that you need to make sure that you understand the difference between a permanent capital loss and just a fluctuation. A permanent capital loss would be obviously something you lose money and you're never going to get the money back ever again. So an example of that would be, let's say you put 100% of your money in a venture capital investment, and then all of the stocks went to zero, or that one private equity firm went to zero. You'll never see that money ever again. This is not what we're talking about here when I'm talking about risk. What I'm talking about here is normal fluctuations. What are the normal fluctuations that you're willing to, that you can stomach in order for you to generate the best rate of return for you? And that is the key. The absolute key to this happiness is figuring out what that uncle point is for you. What level of decline can you accept in order for you to maximize rate of return? And that's really, you can control the risk, but you don't necessarily 100% know what the return is going to be. So the idea is you have a good return process, a process for returns, which is a whole nother topic here. But you want to work within the confines of what your risk profile is to maximize return. That's the whole philosophy that I have here. So that's kind of the concept is known as the information ratio. Statisticians like to use that. So there's a lot of ways to look at this. And one of the ways I like to look at this is under a 6-month time frame. When it comes to fluctuations, what's happening over a 6-month period of time? And you can look at history and you can simulate out various types of portfolios and see what the fluctuations are, both up and down, over a 6-month period of time, and get a sense for what range of portfolio is good for you. So instead of just saying that you want a static portfolio that is, say, 60% stocks and 40% bonds, my philosophy is you want to have a range of risk that you can work within, because opportunities ebb and flow. When there's more opportunities, you want to step on the gas pedal a little bit more than when there's less opportunities. But you shouldn't get out of your comfort zone. A comfort zone, a band of volatility that you're willing to accept. So the idea obviously is to make money. That's the whole purpose of investing. But you have to define, in my opinion, in order to be happy, what that downside is. So the better the reward risk, the better you are, right? So if you can think of this 6-month time frame, and if you can bring it down to what percentage on the downside am I willing to accept over a 6-month period of time, that's a good idea, because a lot of times fluctuations that are rapidly downward happen over a 6-month period of time. You capture much of it. It can get more excessive than that, but you capture much of the pain, if you will, that in a 6-month period of time. So it's really important to understand that what's embedded in that risk number is a couple of different types of risk. There's what's called systematic risk, which is basically what's happening with the overall conditions in the marketplace. These types of risks are non-diversifiable, meaning you can't add another return stream in that particular asset class that will diversify away some of this risk. And those are things like what's happening with inflation, what's happening with taxation, economic growth, geopolitical events, monetary and fiscal policy, factors that affect the whole market. So that's one set of risks, and we want to manage to that. And then there's also another form of risk called idiosyncratic risk, which is basically specific investment risk. And if you're dealing with stocks, for example, that could be company risk. So, if you think about the investment world, stocks are absolutely crucial, because that is business, and that is where most of investment opportunities lie. They lie in the stock world. So you can have company-specific risks that you need to be careful with, like the financial risk, the corporate culture risk, operational risk, and any microeconomic risk in their industry. This particular type of risk is diversifiable. So the idea when you're investing in stocks is to have a good understanding about these risks so that you can minimize them, right? And have the best return for that unit of risk. So when I'm talking about fluctuations here, a good investment is going to fluctuate up and down. I mean, you think about Berkshire Hathaway, the stock that Warren Buffett runs. That particular company has had drops in price of 50% multiple times in its history. Doesn't mean it's a bad investment because it went down 50%. It was a normal fluctuation. Of course, he's a lot more aggressive than people think of. But I think if you hold too much cash or if you hold too much bonds, the safety part of your investment is really a false narrative. It's really a myth. It is not safe to own more bonds over the long term. And I want to explain that a little bit. I did some calculations, a little algebra over the weekend. If you compare what after taxes and after inflation, what kind of return you're going to need to get just to stay even, not just to stay even so that your money spends the same amount after taxes, inflation, your rate of return, depending on your tax rate and your capital gains tax rate and your income tax rate, your rate of return is going to be anywhere from 4 to 5% just to stay even. So if you want to do better than that, you're going to have a return that's greater than that. If you put money in cash, you're not going to beat that. If you put money in bonds, you might barely beat that if you're lucky. In today's interest rate environment, you're not likely to beat it. So you have to invest and have some fluctuation in order to achieve that goal. So one of the ways that you can increase your safety, if you will, is to use a concept that Benjamin Graham talks about. He talks about successful investors, successful investing, he says, is about managing risk, not avoiding it. I love that saying. Successful investing is about managing risk, not avoiding it. So he has this concept called margin of safety. So margin of safety is basically saying, look, if I look at this investment and I look at its cash flows and its earnings and assets and growth, what value could be fair for this particular investment, and how much am I paying for that relative to its value? So if I'm paying a lot less than the value, then I have more safety in that investment for being wrong. My estimate of value, because it's always an estimate, I have more margin of safety. So another way to manage risk is to use a concept of margin of safety in your process. So using quantitative models to try to assess what the value is relative to price is something that's really important. So when stocks go way, way up and they're really getting beyond normal values, you have a higher propensity, a higher chance that you could have more risk in that investment, even if it's a good company like an Apple or a company that's got a stable business. If it gets too far ahead of itself in price, you could really have a lot of risk. So margin of safety is important. So the problem, though, with margin of safety is it assumes that you understand all the fundamentals correctly about a company. Another way of looking at it, and I believe that you should try to understand the fundamentals, and that could give you a basis, but you know that you're not going to fully understand that. So another way to look at it is statistical. And so I'm a proponent of looking at both the fundamentals and the statistical risks, meaning the volatility. So if you look at the statistical volatility, that can give you a sense about the risk. And if you look at the underlying fundamentals, that could also give you a sense of the risk. So putting those two together will help you avoid permanent loss, right? The probability of permanent loss. You want to keep that to really, really, really small. And then there's another thing that you could do. There's two things you can do, three actually, to help with being wrong with all of this. And the first one is your position sizing. How much do you invest? The second one has to do with your diversification, how you blend your investments together that are non-correlated. And then the third one has to do with your overall risk management, actually cutting losses, saying, I don't care whether I'm right or if I'm wrong. Fundamentally, this thing is all I know is I'm losing money on this. It's past my risk budget and I need to get out of it. Regardless of investment, I can always get back in. So if you have those philosophies, added to your portfolio, or if your manager that you're working with does that, that is going to improve your odds of being successful. First, number one, knowing what is your uncle point? Is it a drop of 12% in the next 6 months if that were to happen? Obviously, you're avoiding that, but if that, you size to that, right? Or is it 20% or 30% or 50%, whatever that is for you, in order for you to get the maximum rate of return? Now, a lot of people say, well, I just want you to make me a ton of money and keep the risk very, very, very small. Obviously, we all want to do that. But if you're ever going to try to make good returns, you're going to have downside fluctuations that you must accept, and your sizing needs to allow for that. The more volatility you take, the more potential return, not necessarily that you're going to get. So it's important that you have a good return process as well, things looking for return. So this brings me to an old Chinese, I don't know if you call it just a saying, I guess, an old Chinese saying. If you look at the way the Chinese write in symbols, the word risk is two symbols written together, and one of the symbol means danger, and then the other symbol means opportunity. So you have some danger in any opportunity, right? And you need to assess that. The idea is to be compensated for any losses that you may have. You need to get enough return to be compensated for that. So we talked a lot about a lot of different things, but here are some of the main things to consider about your risk tolerance. Think about your time horizon. How much time do I have before I need my money? Before I need it to either be liquidated, or I need to generate income from that and take more money withdrawals from it. Think about your temperament. How are you, at what point would you capitulate and just say, I would sell out if it went down that far? That's the worst. That's when you really lose money, because then you have a permanent loss. You lock in a permanent loss, which is something you want to avoid. So you want to think about your temperament. And then can you ride out the volatility? You can recover from a loss, right? So if you're younger, you can recover from a downside fluctuation. So stocks appear the most risky. This is something that's really important. Stocks appear most risky when they are not risky. In other words, when they've had a big decline, they appear very risky, but they're actually not risky. So it's counterintuitive. So you have to change your mindset about that. Stocks are the least risky when they appear the most risky, and stocks appear the opposite, right? The most sure thing when they're actually the most risky. So everybody, when you think about volatility, everybody loves upside volatility. So movements up are fine, movements down are not. So we have this asymmetric view of risk. We don't like losses, obviously, and we love gains, but we don't love gains as much as we hate losses. Let me say that again. We don't love gains as much as we hate losses. For that reason, it's important that you manage the losses first and foremost, and then shoot for the best returns that you can. So we're balancing risk, and one thing that is always on people's mind is there's a risk of missed opportunity. One of the reasons why people tend to not do well as investors and are not happy is because when they change their risk, of their portfolio, they miss opportunities. They sell out at the wrong time, and it's better for you to actually have the right position size and hold on to your investments in many cases than it is for you to be in, out, in, out, in, out, in, out. It takes a steadier approach when you're stepping on the gas pedal. So kind of think of it as a speed limit, like from a speed limit of 1 to 99. So 1 would be you're almost at a stop, and 99 would mean you're pedal to the metal. So it's a good idea to figure out what speed limit you want to go to. So for us in our risk profiles, we have 5 risk profiles in our process that we manage money for people. We like to think of things in terms of that speed limit, and for example, a balanced type of a speed limit would be somewhere between 55 and 65. But we also have bands, right? Because we sometimes we step further, harder on the gas pedal and less on the gas pedal within a risk profile, because the opportunities are more or less abundant. So give yourself some leeway. Don't be one of these investors that's just a static investor when rebalancing. And in my opinion, that's not the way to go if you have a good process. So we talked about statistical risk versus fundamental risk. That's something that's really important. We talked about the 6-month time frame. So 95% historical range in 6 months up and down. I think that's a good way to look at it. And the way that you analyze this, by the way, and this is one of the things that we do for clients, is when you're looking at your portfolio, look at each individual investment. Don't just make a blind guess. We enter in every single investment in there, and we look at the return and risk of every one of these and the correlation, how they interact to each other, and then make some kind of statistical observations about what kind of risk that what speed limit or risk limit that particular portfolio is in your portfolio. Does it match your risk profile? So you want to know what that is. And so you want to also look at an outlook too. So not just a historical, but what is the outlook? And you could do stress testing and things like that, where say, okay, what happens if we have like a 2008 type of a market again, or what happens if we have a rip roaring bull market? How much of the upside would you capture? So risk-adjusted return is another aspect that you want to look at, and we like looking at it almost like a grade point average. So, like if you have a 4.0, that's pretty good, right? That's really good. So you want to know how efficient your portfolio is, the return potential per unit of risk, and that's a really good way of looking at your results. And we also want to look at each individual investment's risk and its contribution to your portfolio, because you might have a stock, for example, that is creating a tremendous amount of risk in your portfolio, even though it's a smaller percent, because it's very volatile. So you want to understand, is there anything that is in my portfolio that is creating a lot of risk, but it's not a good opportunity? Maybe I've got too much risk budget, if you will. We think of it in terms of risk budget. Maybe we have too much risk budget associated to a particular investment, and we should scale that down. Maybe not get out of it, but scale that down and add more risk budget for your better opportunities. The idea is it's like budgeting your checkbook back when we used to use checkbooks. How much are we going to allocate towards things that are the most productive and most utility for us? In the investment world, obviously, that is the return. So that's pretty much it. Now, I want to talk a little bit more about risking forward. There's a book out there by Victoria Labalme, a book called Risk Forward. It is a great book, and one of the things she talks about is the fog. The fog is a period of time when you're not sure what's going to occur. Your path is not clear, and I'm talking about in your life. Your path is not clear. You're not sure. You're not sure what your next steps are. Maybe you're in a creative mode. You're kind of in between periods. When you're in that type of situation, you have to be sure that your risk profile is subdued a little bit, because you may be making some changes. So think about that in your life too. What's going on in your life? And when you're in a phase of discovery, you don't want to be asking questions about goals and things like that as much, because you're kind of in a transition period. So you want to lower your risk level as you're thinking about that. One of the things that spurs this a lot is divorce. Divorce creates a tremendous amount of uncertainty, or health issues, things like that. You definitely want to subdue your risk profile in periods of uncertainty like that, the fog, if you will. So don't be rushing. Don't be worrying about your portfolio. Don't be trying to conform to what other people are doing. You have to think about your situation. Just because somebody else is doing something, you don't want to adjust your risk profile. So no rushing, no comparing. Don't compare yourself to others. Try to prove to yourself what is right for you. Don't try to go and listen to what everybody else is saying. I mean, listen to advice, obviously, but you have to kind of look within in your creative process for where you are, and don't get too risky and make rash decisions at that time. You just got to feel like you've got your house in order, because emotionally, bad decisions can be made if you don't do that. So that's all for risk management. If you want to have a risk assessment of your portfolio, just let us know. We can send you a questionnaire that you can answer online, and we put in your portfolio, investment portfolio, into models, and we could show you what your risk profile, what speed limit your portfolio is going at, and then you can assess, is that the right speed for me? And you might even find some ways to increase your return and lower your risk at the same time. Well, that's all for now. I'm Louis Llanes. This is the amazing new podcast that we've come up with that I'm so excited about really helping people learn from. The Market Call podcast is something that we have been planning for a long time. And we decided we were going to talk about risk because early on, we were going to talk about risk early on because we know that this is so important and we get more and more questions about that. So hopefully you got something out of this. Be sure to like and subscribe, comment, and give us some comments, some truthful comments of ideas and things that you liked, didn't like, and give us a 5-star rating review if you liked it and share it out. Have